Hello, everyone. We are live. Thank you so much for tuning into this one. I had a lot of fun with this presentation, actually. So, today we're going to be talking about WeWork. So, let me go and share my screen. All right. All right. WeWork, bankruptcy or meme heaven. You can see this meme over here. This SoftBank companies burning cash with no clear road to profitability. So that's WeWork in a nutshell. I've been around the tech space for a while, since maybe around 2020 or so, even earlier than that. And WeWork was known as that company that is like the poster boy for failed tech overhyped companies. So I'm really excited to talk about this one today. I decided to revisit it because what I noticed is looking at the stock chart over here. I was actually surprised to learn that this company actually IPO'd because in 2019 there were so many stories coming out about this company, and it seemed like it was going to go bankrupt, and I never really took a look at it past 2019, 2020. When the pandemic hit, I assumed that this company, being a company in the subletting space, and if everyone's staying at home or working from home, then subletting is probably gonna, go away. So I thought that during that time, WeWork was just going to declare bankruptcy, and amazingly, they did not. And I find out later that in 2021 they actually went and IPO through a SPAC. And this company, as you can see here, IPO'd at a stock price about $400, had its ups and downs, and then recently something must have happened, or a bunch of things probably happened, and it went and dropped 98% to the price about $3.10. So whenever a stock goes from a well-known company like WeWork, going from like $400 to $3, it always presents an interesting opportunity, because you never know. Maybe people are overly pessimistic, or maybe there's an opportunity for investor to come into WeWork and see if it could be possibly a good investment. So today I'm going to be walking through what I think about WeWork. And it certainly is a company that has a very rich history. Everything about WeWork is something that gives it meme stock status. This company was valued at $47 billion in 2019. Now I think it's about $165 million valuation. The man, the myth, the legend himself, Adam Newman. There's so many stories about Adam. I hear he's actually back promoting his new startup called Flow, which I'm surprised he managed to get $350 million of funding for. But he's known for a bunch of things: smuggling weed on a private jet to Israel, trademarking the word "we" and then selling it back to his company for $6.5 million. There was a story about how when he decided to lay off a bunch of employees, he celebrated by having Run DMC come in and then do a live concert. Unlimited beer, $60 million private jet, which actually in a recent interview, he actually persuaded, or seemed like he persuaded everyone that it was actually really important to business operations. So he is a very interesting character, and there's no shortage of really fun stories with WeWork. Now, um, I mentioned why I think this company might be interesting to look at. I think there's definitely some things about the WeWork business model I think that could theoretically work. And how WeWork makes their money, they have three primary revenue streams. The first revenue stream is called Space as a Service, which is a very clever, gimmicky marketing way of so that they can use the acronym SaaS. But Space as a Service basically is like a company. WeWork primarily serves tech companies, so startups, enterprise companies like Google, I think, uses them. I believe Meta as well. So how it works is these companies, or whether startups or large companies, they want to have flexible workspaces because if you're not certain about headcount, especially in the days after Corona, when a lot of these tech companies trying to call their employees back, and the employees, a lot of them don't really want to come back to the office and want to stay working remote, or you have employees who want to be in a hybrid model where they come in about 2 or 3 days out of the week. Um, as well with tech companies right now going through layoffs, and I believe there's still going to be rounds of layoffs coming through, or restructuring, however you want to call it. These companies sometimes don't know how their headcount is going to look. So rather than getting a long-term lease for 10, 15 years and doing capital expenditures in order to build up an office that later on they may not use, a lot of these companies would actually prefer to use a service like WeWork, where if they need their employees to be at a certain place at a certain time in the workplace, they can just go on WeWork, rent out to space online, and normally the typical range of how long a tech company rents out a WeWork office could be anywhere around 19 or 20 or so months. And you can rent out desks, you can rent out private offices, whole buildings, even sometimes a floor. But that's where WeWork makes primarily most of their money. WeWork is the company that would go and actually get these long-term leases for 10, 15 years or so. So they take on that risk. And then they would then sublease that company, that space to the tech companies that need it. So WeWork lately in 2020 or 2021 or so, they launched their all access pass. Now, this is the second way that WeWork makes money. Essentially, they're selling memberships that provide them recurring revenue. And these memberships allow anybody to be able to work in a number of different WeWork locations. There's actually about 700 of those worldwide. And wherever there is an empty vacancy, they can go into that WeWork and actually use that office space. So I think this all access pass more is tailored towards smaller businesses or startups, or individual contractors who maybe are like software developers, for them to be able to work wherever they want to, provided that there's enough space. And their third method of generating revenue is through their WeWork workplace software solution. This is through a partnership they have with a company called Yardi. Essentially, it's a solution that's tailored towards enterprise companies for them to manage their WeWork footprints. So being able to track where the employees are at whatever given time, helping employees be able to book rooms whenever they need to, and also just providing tools in general to help these enterprise companies make the most out of their WeWork investment. Primarily, the vast majority of WeWork's revenue comes from their space as a service solution, which is those 19 or 20-month leases. Although they are trying to grow their all access demand passes in order to help fill up occupancy for a lot of these locations. And the workplace solution, of course, is very high margin, but it makes up a very low percentage of WeWork's total revenue at this moment. So WeWork is one of the biggest office leasers in the world. If we look at just including joint ventures as well as unconsolidated franchises, they have about 781 locations, almost a million different workspaces, and there's about 664,000 or so physical memberships, 77,000 all access passes. The bottom here, it shows their consolidated, which is these are the regions that are under the WeWork brand, under the WeWork umbrella, while the system-wide ones are including like affiliated franchise as well as joint ventures. So it's a pretty sizable footprint that WeWork has. And if we were to just look at those individual factors for WeWork, you might not actually think this business is actually all that bad. In fact, the business model has potential. But the main problem with WeWork here is its balance sheet and income statement. you can see here that they really don't have much cash. And WeWork has notoriously been very famous for lighting money on fire. I think around the time, I think it was 2019, they were losing like five or $6,000 per minute or something. It was something nuts. Right now, they have improved their unit economics a little bit, but they are still very much bleeding cash. They have about $744 million in current assets, about 9,275 million dollars in the assets they have for leases. So being able to use the spaces that they currently have. However, if you look at their current liabilities here, you can see that they owe 2,189 million throughout this whole year. So they are definitely facing a liquidity crunch. They are in danger of not being able to repay a lot of their lease obligations as well as just their bills in general. And you can see here that this long-term lease obligation number is about $4 billion more than the assets. So, what probably happened here is WeWork around when they were doing their blitz scaling and going big, go big or go home. They probably didn't negotiate very good lease agreements because now they're valuing the asset much lower than the liability of being able to use those workspaces that they've engaged in long-term leases for. So this is a big problem for WeWork right now, and they also have about $2.9 billion in debt. Recently, actually, in around March or so, they were facing a liquidity crunch, and they had a bunch of debt that was due in 2025 that they had no way of paying. So what happened was they took some of this long-term debt, and about $1 billion of it got converted into equity. So this was from SoftBank's end. What happened was SoftBank was like, you know what, take $1 billion, convert it into ownership in the company. And what WeWork did was they issued a bunch of new shares, gave them to SoftBank, and diluted the hell out of all the other shareholders. So that happened. The interest rate for the debt that got pushed out, because they pushed out some of the debt from 2025 to 2027, and the interest rate for those debt pieces went from 5 to 7% to like 12 to 15%. So it's pretty crazy. Although the interest rate isn't that bad because a portion of it, I believe it's like maybe 7% or so, or 7, 8% of it is paid in stock. So it's not the worst thing in the world, but still, they definitely are facing a lot of liquidity issues right now. If we look at their income statement, you can see that WeWork has been making some progress towards becoming more profitable, but they still have a long way to go. You can see here that they do make money on their lease operations, but their margins are pretty thin. I think their margins, gross margins, are probably around 10 or maybe 15% or so, 15, 16%. But WeWork has very high G&A expenses. And the reason behind this is when you take on a short-term lease, you have to worry about keeping your customers happy. So there's expenses involved in making their workplaces look nice. In fact, that's really WeWork's main differentiator or value proposition, let's just say. I was watching an older interview of Adam Newman in 2017 trying to explain why his business should justify a $47 billion valuation. And it was really funny because the interviewer kept asking him, so like, what's your competitive advantage, Adam? And Adam was just being like, listen, our business is about making sure people can grow together, can motivate each other, can live communally, and we have that energy, and the energy is what makes us valuable, something to that regard. But I guess 3 or 4 years later, they still haven't figured out much of a competitive advantage. WeWork's main competitive advantage is their brand recognition, where they spent about $18 billion or so in order to get, as well as the fact that they do have a nice design aesthetic to a lot of their rooms. So A lot of WeWork locations have like free beer. They have kombucha machines. The area looks very nice and very minimalistic, which appeals to a lot of people in tech. But in order to keep that and make their areas look nice, they have to spend money to do that. And if there's a customer or a startup that goes out of business, well, WeWork then has to spend money to try to fill that vacancy or that occupancy. And God forbid an enterprise client churns, because if an enterprise client churns and WeWork can't find another enterprise client within that same quarter, well, their occupancy rates are going to suffer as a result. So to keep occupancy rates good and to make sure their clients are happy and that they have like really nice decorated rooms and equipment and desks and chairs, sofas, they need to invest a lot of money into upkeeping all of that, which is why their G&A expenses is so high. All right. So let's actually go into what exactly is going on recently. So there's this guy named Sandeep Mathrani, I think that's how you pronounce his last name, and he was brought in 2020 in order to fix WeWork, because when WeWork released their S1 in 2019, everybody freaked out because all sorts of things came out about how Adam Newman was buying big apartments and then leasing them to WeWork. It was doing all kinds of crazy spending things like getting a private jet, going into We Live, which is like trying to do WeWork, but like the residential version of it. There's also We Learn, which was something managed by his 5G conspiracist wife, Rebecca Newman, who wanted to reinvent education. They were making a bunch of weird investments in different areas, and investors, when they read that, just freaked out. So the blowback was pretty hard for that. Eventually, what SoftBank did is they showed up to Adam Newman and was like, "Listen, bro, you have to go. We'll pay you $1.7 billion so you can leave, but you gotta hand over control for the business." So Adam Newman took the $1.7 billion, wiped away some of his tears with it, and he ended up leaving. And they brought in somebody actually with a lot of really good real estate experience. So Sandeep was originally pretty high up in a company called Brookfield. He was actually part of Brookfield Properties. So they brought him in, and his goal was to right the ship. But while he did make a lot of progress in improving the occupancy rates as well as unit economics and saving some money and renegotiating some of the leases, he was rather inconsistent in when he thought WeWork was going to be profitable. So at first, he was like, "We're going to be free cash flow positive by end of 2022," and then that didn't happen. And then he went and in an earnings call was like, "We're going to be free cash flow positive in Q1 of 2023," and it didn't end up happening. So in their most recent call, that was in Q1 of 2023, he kind of got grilled by a lot of analysts. Analysts were like, "Listen, when are you going to be profitable, man?" And he said, 2024. And the analyst was like, "Are you sure? Because you made a bunch of promises before that you couldn't keep." And I was like, "Absolutely, 100%. I am positive we're going to be free cash flow positive in 2024. And it was kind of a back and forth. The analyst wasn't taking any BS from Sandeep. And actually, very soon after that call, he ended up leaving the role or ousted from the role. Actually, I don't know why he actually left, but him and the CFO both left. And maybe it was the board freaking out. I don't know. But Sandeep is no longer with the company anymore. Now we have our new guy. His name is David Tully. And he took over, and as well as a bunch of board members left the WeWork board, and new board members came in. Everybody who was brought in, including David, they're not really real estate people. I think David is from the satellite space where he was a CFO. His primary expertise seems to be M&A, risk management, finance, and a bunch of other board members also got brought in with finance backgrounds. Some of them worked for like energy utility companies, so they don't have much real estate experience. Their main expertise is finance, banking, investing, and it seems like what the priority is now is number one, preparing WeWork for bankruptcy, or two, trying to do everything they can in the near term to make sure WeWork stops bleeding money. So recently, they released a statement, I believe, sometime in August, where essentially, if we just cut out the corporate jargon, essentially they're saying they might go bankrupt. And they came up with a plan, which is how are we going to make sure we don't go bankrupt? And there's 4 stages to this plan. I'm going to cut out the corporate jargon. Essentially, what it is number one, can we make our lease agreements more advantageous? Can we make sure our long-term rent goes down? Can we bring in more money from our customers and reduce churn? Can we spend less money? And 4, can we raise money? And this is ultimately the core that you need to look at for WeWork, because right now the company is priced at about $165 million. It's basically almost zero at this point. If they didn't do that reverse stock split 40-1, it'd be easily a penny stock. And right now, WeWork does seem to be doing pretty well on the revenue growth side. This year, they grew, I think, 27%. The CEO kept going and saying how WeWork was taking market share and they're doing really well. But ultimately, if you're going to make an investment decision in WeWork, you have to examine how legit is this transformation strategy. Because if this transformation strategy ends up failing, then WeWork's going to go to zero. So, what is the plan to renegotiate leases? Well, can you just go to your landlords who provided you long-term leases and say, you need to lower it? The plan for renegotiating leases actually is summed up very well in this meme, which is if I die, you die. So how it works right now is there is a lot of excess supply of office real estate because we had the pandemic, and obviously there were vacancies during the pandemic. But when companies are trying to put their foot down and get employees to come back to work, a lot of employees are like, listen, I'm not going back to the office. I like working from home. I'm more productive working from home. I'm just going to stay working from home. And some employees are begrudgingly coming back, but are saying, listen, I am not going back 9 to 5, 5 days a week. I'm going 2 or 3 days tops, and the rest of the days I'm working from home. And if you try to force me back 9 to 5 into the office, I am leaving. So right now, that is the case right now. So especially in the US and Canada, the office occupancy is like, there's a lot of soft demand right now. So what WeWork can say to these landlords is, listen, we have to do what we need to do while demand is soft so that we can stay in business. So you better lower our leases, because if you don't lower our leases, we're going to go bankrupt. And then there's going to be a huge amount of real estate that's going to be dumped in the US and Canada, as well as a bunch of different other locations around the world. And with that excess supply, it's going to make the process of trying to attract demand for your office space even harder. So, you either lower your rates and keep me around and I help you make sure you can fill your offices, or you make us go bankrupt. You say, no, we go bankrupt, our tenants leave, and then you have to find brand new tenants, which might actually cost you more in the long run. Now, will this plan end up working? Well, I actually don't know. I was looking into one of their competitors, Regus, and their leases are a lot more favorable than WeWork's. However, WeWork also, I believe, ran into a lot of these leases while they were in hyper-growth mode, and they weren't actually really thinking about negotiating good leases, while Regus went bankrupt, and then they had time during the pandemic to negotiate their leases. So that might be why their leases are a little bit more favorable than WeWork's, but I don't know whether or not this is going to work. There's some landlords right now that are suing WeWork for unpaid leases. It's a compelling argument, I suppose, but it's kind of like the nuclear option right now that WeWork is using. What are the chances of WeWork actually increasing their revenue? Well, they have 2 really good aspects of their business. The problem is these 2 aspects are they make up too little of the revenue for WeWork to actually mean something. They have their all access memberships, and this is probably the most significant of everything, and they've been growing this steadily quarter over quarter. However, right now, it only makes up about 59 million of their total revenue. If they're able to increase this and like accelerate it, let's say there's like 80,000 all access memberships, maybe that ups their all access revenue by about 10 or 20 million dollars tops, which, to be honest, isn't really going to make much of a difference. So this is a great thing that WeWork is doing, because the all access memberships essentially helps them to fill their vacancies, because it gives people the ability to work anywhere as long as the space is available, and it drives more demand to the underutilized portions of WeWork's portfolio of rental areas. It's a good idea, but I think it was launched a little bit too late. It was launched in Q2 of 2021, and I don't think it's going to drive much of a meaningful impact in the future. Next, you have the WeWork Workplace, which is an enterprise software solution for enterprises to manage their workspaces, book workspaces, track how productive they are. And unfortunately, I don't think this makes up a big chunk of WeWork's revenue either, because they have about 68,000 licenses. I can't imagine any enterprise paying more than about $100 or so per license, because I don't think it's that valuable really to pay more. So maybe this makes up $6 million, $10 million of WeWork's quarterly revenue. I also think this is kind of negligible. It's a high margin for sure, but I don't think it's going to make too much of a difference. So the only way that WeWork really can extract more value from their clients and reduce churn is through their space as a service solution. And you can see their occupancy has grown from 50% in 2021 to 75%, but recently it's tapered back to 73%. Looking at this, I'm going to guess that right now, because of the weakness in office occupancy, it's not just for WeWork, but all around, I don't think WeWork has too much pricing power here. Because it's like, if an enterprise needs to use, let's just say, a space, or WeWork is mostly serving tech companies. It's essentially a tech brand. So if you have tech companies that need extra space or extra flexible space, then WeWork is one of the leading options. But the question is, do these tech companies really need more space? Or are they going to just let employees work from home? Or a lot of this uptick, I think, was due to companies putting their foot down and saying you have to come in at least 2 or 3 days a week. But has that tapered off already? Because recently you can see it went down to 73%. In the recent quarter, it actually went down to 72% occupancy. So have we kind of exited that point where there's more occupancy because there's mandatory return to office? But now, are we in a permanent state of hybrid work? Because if we are, it's going to be hard for WeWork to pull this, especially in Canada and the US, to pull this to an 80% occupancy rate. If we look at WeWork's total revenue overall, you can see Canada and the US, they make up about 38% of the revenue, but they're only occupied 69%. Everything else seems to be doing okay, but the Canada-US portion is right now a serious drag right now to WeWork. Now, I've looked through some articles here. Office vacancies continue to rise, even though there's return to office mandates. The main reason behind this is people just don't want to come back to the office, really. This does help WeWork's case, because tech companies, especially because of the recession, are unwilling to engage in long-term leases and to make huge capital expenditures that may not pay off. So if they are going to need extra office space, then WeWork is a top choice. But will they continue to need it? Is this something that's going to make significant growth within the next 2 or 3 quarters before WeWork goes bankrupt? That right now is pretty uncertain. Also, if WeWork is trying to cut down on their SG&A expenses, are they really going to develop new products or ways to capitalize on increasing their ability to acquire clients? I think that's pretty pretty tough to do. And I think right now WeWork really is in a position where they're more of a price taker than a price maker. And I don't know if demand for flex offices are going to increase that much. But looking at the trend right now, it's the demand seems to have tapered off after that initial point where in 2021 it was like a mandatory return to office. Um, Looking at G&A expenses, I mean, how much can you actually cut? I imagine the idea of cutting G&A expenses probably has been going on over the past, let's just say, 4 years or so since WeWork had that disastrous $47 billion valuation. I think around this point, they're kind of reaching that point where they are not really sure how much G&A they can cut. You can see here they've done a good job since March 2022. They've brought it down maybe like 15 or 20% or so. But you can see from December 2022 to June 2023 hasn't really moved all that much. And I think it's because you can only cut G&A expenses and operating and selling expenses so much before it becomes not a good idea to do so, because if you cut more people, you're not going to be able to operate as a business. And it looks like WeWork has unfortunately reached that point. So finally, we have the last possible option that could save WeWork as a company, and it's the man, the myth, the legend himself, Masayoshi Son. You can see this is from a very interesting presentation he gave. 25 minus 4 equals 9. So there's actually context behind this. I think this was a presentation where he was trying to justify the fact that SoftBank is undervalued because they only have 25 billion assets, 4 billion in debt. So why are they worth $9 billion? Well, I decided to use that just because it's funny. But anyway, the last possible way that WeWork can escape is if SoftBank rescues them and gives them more money. And Masayoshi Son kind of has this option where it's option A: do we light more money on fire in the hopes that WeWork can finally break even? Or two, do we just eat our $22 billion loss and call it a day? And it's hard to know what Masayoshi Son actually will do. I think it all depends on how successful they are in negotiating their lease agreements and if occupancy rates climb up. If they climb up to a sufficient degree, then Masayoshi might be like, look, I'll throw you a couple $2 billion. Hopefully you break even and we are able to rescue some of our falling equity prices, which I imagine if they invested at $20 billion and the stock's worth the company's worth $165 million right now, they're probably not in a good position to do that. But if the lease renegotiations don't go well and occupancy continues to trend down, then I think SoftBank might just decide to bite the bullet, take the $22 billion write-off, and go on with their day. So I really don't know. I think recently they have canceled some of their debt, turn it into equity. I don't know what their thought process is going to be right now, but neither option is very appealing for them currently. So what's the verdict behind WeWork? I think it's an entertaining investment opportunity. I think it has a great story. It could be a meme stock. Again, not financial advice at all, please. I'm not a registered financial advisor. I think it's a pretty bad investment because when you're trying to make investments, I can't see Warren Buffett fucking putting money into this company because there's too many uncertainties right now. It's like they have a lot of debt. The only thing WeWork really has going for it is that it has a nice name, and they seem to be okay at designing their offices and making it look pretty. But in terms of, and the business model theoretically could work if they had executed it well from the very beginning, and if Adam Neumann didn't blow a ton of money on private jets and whatever the hell else he spent the money on. But right now, they're in a position where their margins are going to be razor thin even if they do break even. And a lot of this is based on whether or not the nuclear option of renegotiating their leases, again, it's like if I die, then you die, if that's actually going to work. If it does, WeWork could potentially rebound quite a bit, even if there's some good news. But if it doesn't happen, then they could very well go to zero. A lot of it's dependent on SoftBank as well, whether or not they decide to cut WeWork another check, or if they just want to take their $22 billion and write it off. I think if you were to play WeWork, it wouldn't be a investment opportunity, it would be gambling. If you want to gamble away some money, take some money, buy some call options with an out of money strike price, and see what you can do there. Because it's sold down so much where there could be some retail speculation if some minor good news comes out, but overall, I don't think this is a very good investment, unfortunately, which is a shame because I do like it when companies like this present a hidden opportunity. Right now, I don't see one except one to maybe gamble a little bit and have some fun. So that's my analysis of WeWork. Thank you so much for coming by and tuning in. If you tuned into my PayPal stream a few days ago, thank you so much. I'll have some more serious investments like that shortly, but I just wanted to give this a shot just because, I've known about WeWork for a long time, and it was good just to re-examine them and see if they're worth taking a look at. But thank you so much, everyone. All the best to all your different investing journeys. And please like, comment, and subscribe. Let me know if you want me to analyze a certain company that you're looking at, and please have a good evening, have a good day, depending on when you're watching this, and I will see you soon. Thank you. Bye.